Realty Income is down 18% over the last 12 months and even year to date down 8%. So is this a company that is undervalued? Should we be looking to buy more, or is it time to consider selling? We're going to take a look at different options in today's episode. We're also going to refresh our memory on their latest earnings, their top line revenue growth, as well as their bottom line net income to spot any issues. We'll also consider the health of the company, their total cash versus their total debt, and we'll see how they've been performing year to date over the last few years versus some of their competitors in the real estate investment trust industry. And we'll touch upon their financial metrics, their dividend safety. Are there any notable changes that we need to be worried about in terms of their future? And we'll look in the more recent quarter if institutions have still been buying Realty Income or they've started to move away. And we'll discuss some insider selling that we have noted, although this isn't very recent news. And one of the most important things for a REIT are those interest rates. We're going to take a look at an article that talks about how the Fed said it is not far from essentially cutting interest rates, whether this is very bullish for the REIT industry as well as Realty Income in isolation. And we'll talk about how that affects their internal debt structure, both fixed as well as variable. And we'll remind ourselves of some slides that we did note in their latest investor presentation and the general portfolio, how high quality is. Are there any companies within this or any industries we should be worrying about overall? And don't forget, we will run them through the updated valuation, getting to the intrinsic value, our acceptable buy price with that investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. So let's jump into the historical performance. Now, it hasn't been the greatest start to the year. It is down 8% over the last year, as we mentioned, down 18%. And over the last 10 years, however, we do note they are up 29%. Bear in mind, this doesn't include those dividends reinvested. And for those that are new to this company, they do pay dividends every single month. We see their all-time highs pretty much at that pre-pandemic level in February 17, 2020 at just under $80. Now, they are currently trading in the mid to lower end of the 52-week range. The yield is at 5.82% and their market cap sits around $46 billion. So let's take a look at their numbers. Let's refresh ourselves on the latest earnings report. And as always, for REITs, we want to see at least 5 to 10% top line growth. 1.5 billion they reported in 2019. Fast forward to 5 years later, 4.1 billion. So what's positive to note here, in fact, they have more than doubled their top line over the last 5 years. And what I like to see here are those year-on-year increases. So a very positive start in terms of their income statement. Bottom line net income, a little bit of a different story. We do note their bottom line net income, 437 million, has essentially doubled over the last 5 years to 872. But we do want to point out that we can see, whilst it did increase to 2020, it did fall down in 2021 before increasing and then another increase. So small inconsistency to their bottom line net income, but in conclusion, top line and bottom line increasing over the longer period. Quick look then from their latest report for the health of the company. Their cash has increased from 54 million to 233 million, which is fairly positive, but it is quite important to understand the movement numerically and directionally to that total debt. And it has gone up quite significantly from 8.1 billion in 2019 to 22.1 billion from that latest report. So cash has increased very slightly, with their total debt increasing at a very, very rapid rate. Something that is typical for REITs, but again, we need to take a look at a few different metrics, their adjusted funds from operation growth, as well as their net debt to EBITDA, which will also correlate to that dividend safety. Now, when we do take a look at others in the retail REIT industry, Simon Property Group, a popular one, Kimco Realty, Regency Centres, and a few others, over the last 12 months, so what we can see, in fact, Realty Income, the worst performing, down 13%. Bear in mind, this does include if you would have reinvested those dividends, so you would still be down. We can go even more essentially relevant year to date, so the last few months. Realty Income, although not the worst performing, they are still down 7%. And when we extend that to the last 5 years, Realty Income, again, one of the worst performing, down 2%. So the overall theme for Realty Income, they are down every single analysis we've looked at year to date, over the last year and over the last 5 years. But one thing we would say is, bear in mind, past performance isn't an indicator of future performance, and the increase in interest rates that we have seen over the last few years has really hurt Realty Income. Now, in terms of their dividend safety, before we take a look at that, there are a few things just to cover. Institutional ownership is still pretty high, 79%. 1.71 billion worth of sales by the institutions over the last 12 months, with a lot more buying over the same period. So not only do we see a lot more buying by the institutions over the last year, but in the more recent quarter, Q4, we do see them buying more. And what's quite nice to note, if you are a shareholder, every single quarter over 2023, institutions were buying more shares. So we can clearly see they are very bullish on Realty Income, and I do believe that they sense with the interest rates coming down, it will affect Realty Income in a positive way. One thing that we would like to draw your attention to, insider buys, insider sells. What we see, although we do note this is from the 18th of December, this was the more recent news, so there has been nothing more recent than this. Larry Chapman, the director, did sell around 3,500 shares at an average of $57 for 200,000. Again, something just to be transparent, but realistically, insider selling isn't very much of a bearish signal, but we do like to draw your attention to that so you are made aware of any moves, whether that's insiders as well as members of Congress for today's episode. Now, in terms of the interest rate, so we do here see that Jerome Powell, the Fed chair, has said that the Fed is not far from the point of cutting interest rates. So that will be very positive news for essentially all of REIT, not just Realty Income. Now, they do mention within this article that they essentially want to be a lot more confident before inflation is, or in fact, before the interest rates are cut. They want to see inflation moving sustainably at 2%. And they did say when they get that confidence, they will be looking to cut it. And in fact, they're not even far from it. So it looks like it could be coming very soon, whether or not we see it in June, which is what some of the banks do believe, or we see it towards the end of this year, which is where I would be putting my money if I had to bet. It does look like it could start to be more positive for REITs. And the reason why we are very bullish on when these interest rate cuts, that it will affect the REITs, because all we have to do is look towards history, and this is something as a refresher. We see that essentially once the Fed is finished tightening the cycles, we can see from that quarter plus one to the next quarter, 10%, which is essentially public real estate, outperforms equity market every single quarter, in fact over the next 4. So this could be really bullish if this is something that we do see happen this year, so something just to bear in mind. But what I would say is, in terms of the actual structures of the companies like REITs, it won't have a massive effect right now. The reason for this, well, firstly, just to draw your attention to the fact that they have around total consolidated debt of 21 billion, plus we can add this proportionate share, total debt of 22 billion, of which the total fixed rate is 94%. So they already have 94% of their total debt being fixed, and from this we can see here 86% of it is essentially on an interest rate of 3.77%, and that essentially is until maturity of 6.7 years. So there is no real need right now for Realty Income to refinance any of their debt. As we mentioned, the vast majority is fixed for quite some time, for around 3.77% at 6.7 years. So even though it will probably come down and may be very bullish for Realty Income and REITs in terms of the actual structure of their debt right now, this isn't going to have a massive effect. So something just to bear in mind. Now, a few things that are quite bullish with Realty Income. For those that missed the last episode, Realty Income did purchase 82 assets across 5 countries for 527 million euros, and we can see here that Decathlon was part of that. They essentially, as we can see, did a sale and leaseback, which is very positive. They are essentially the world's 3rd largest sporting goods retailer, and they generate quite a significant amount of revenue, so there are no issues with the company itself, and they do have a fairly strong investment grade profile as well. Now, a few things to note that a lot of people always tend to say is about some of the tenants looking like they could be on their last legs and leaving. Again, that is very subjective, but we can see they don't have a very large proportion in any one tenant. The highest is Dollar General at 3.8%. Walgreens, again, 3.8%. You do have, in fact, in here quite a lot of quality companies that I would personally see no issues with them over the long term. B&Q, FedEx, Wynn Resorts, even 7-Eleven, Asda, Sainsbury's, Tesco's. These are all really big companies. You really have to believe that a lot of these companies and their tenants are going to leave for there to be any kind of concern with Realty Income. And even if you believe that that is the case, you then also have to be bullish on the fact that you don't see anyone coming to replace their tenants. In my opinion, that is very, very unlikely. I see no issues not only with these clients that they have, but if these clients were to leave, which I do see is unlikely, whether they would have any issues replacing them. On top of that, when you actually look at the industry diversification, grocery stores makes up the largest of 11%, and then you have a lot of different industries with a fairly decent amount. I mean, home improvement, the likes of Home Depot, Lowe's, 5.9%, restaurants, which in my opinion will still always be here over the foreseeable future, health and fitness, automotive service. So there are no real issues from even the industry perspective as well as the client perspective, in my opinion. And on the geographical diversification, it is quite nice to note that they have around 12.6% outside of the US in the UK. So again, a lot of diversification, which has also helped with their essential acquisition merger with Spirit Realty Corporation. Now, before we jump into the essential metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles we have, all completely free, click on that pinned comment below and you can gain instant access. Now, dividend safety score still looking safe. We still have that 80 score. Market cap is 46 billion. It is a large cap company. In terms of those recessionary metrics, for those that are new to the channel, well, they did increase it during the last recession. They had above average growth, -1% versus the S&P's -12%. And they also slightly outperformed the S&P with a -43%, with the S&P coming in at a -55%. Now, dividend growth is a little bit somewhat lacking, 3% over the last 4 years, 3% over the last 5 years, given the fact that on this channel we want to see a minimum of 4%. The reason why we always say a minimum of 4%, well, is because the US inflation rate over the last 40 years was 4%. If you're getting anything less than that, whether it's your salary, your dividends, your other income-producing assets, you are in fact taking a pay cut and losing your purchasing power. Something to consider, we do see over the last 20 years, 5% on average. And we do note they are a dividend aristocrat. They have increased dividends for the last 25 years or more. And they also have paid dividends for the last 55 years without a reduction. Dividend yield theory then, again, for those that are new, states the company is undervalued when the current yield sits above the 5-year average. 5.82, it is above the 5-year average. We also see a double sign of undervaluation with the forward P to FFO very low at 12.7 versus the 5-year average. In fact, one of the lowest obtainable over the last 5 years from what we can see. And we do note now it is also lower than the real estate sector P to AFFO. In terms of the free cash flow payout, it is what we always draw your attention to. However, for REIT, a lot more volatile, the payout, so we do focus on the adjusted FFO, funds from operation. Below 90%, the blanket rule for REITs, we can see it has been decreasing, and with 76% in 2023, 74% in 2024, no real issues to note there with that safety. Adjusted funds from operation, you always want to see this increasing for REITs, in fact for the majority of companies, so very positive to note year-on-year increases. $4 in 2023, $4.16 expected in 2024, so we can see that hopefully that essential synergies with the Spirit Realty Corp merger is looking like it will start to pay dividends and will come into fruition nicely. We do note the adjusted FFO per share growth has lacked in 2023, but nice to note it is increasing to around 4% in 2024. And sales growth, remember 5 to 10% was sort of the minimum baseline we want to see. They have achieved that every single year. 22% in 2023, the more recent period, looking nice as well. And for those that always like to see the numbers, well, here it is, 930 million to 4.08 billion in 2023. Again, with REITs, always very typical. If you keep watching these episodes, you'll see that it does tend to increase quarter on quarter. The reason for this, they do essentially depend on issuing equity to fund property acquisitions. As we can see here, they do retain little of that internally generated cash flow after paying dividends. As we mentioned, some REITs do dilute your position at a quicker rate than others. It's just the name of the game. Realty Income is one of those, unfortunately, that does dilute your position at a faster rate. ROIC, return on invested capital, 3 to 5% for REITs. It has been at the bottom end of what we want to see over the last 3 years, something I'm personally keeping an eye on. I don't really want to see it below 3% like we saw in 2021. In fact, after the merger, I would like to see some synergies and see this at a minimum at 5%. Operating margin looking healthy even after a slight dip over the last 10 years to 42%. Maybe something to keep an eye on if it continues to dip, but 42, low 40s is looking pretty healthy. Net debt to EBITDA, now this is important for the dividend safety, earnings before interest, tax, depreciation, and amortization. Remember, this affects not just the dividend safety, but also shows us the balance sheet strength. Now these are the number of years it would take the company to pay off all of their debt net of cash on hand. 6.05, I mean, to be fair, we can see it pretty much above the 5.5 every single year. We want to see it below that. 6.05 in 2023. The positive that I'm taking from here is that in 2024, it is expected to come well further than 6.05 to 4.75. There's something just to keep an eye on, given the fact that for the last 10 years, it has pretty much straddled around that level. Let's jump into the valuation, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the valuation. The first model, we have the multiples valuation model. We have companies in a similar sector and size that we just ran through. We have the average P to AFFO for these companies, and we have the P to AFFO of Realty Income to get our intrinsic value of $66. So we have that first sign of undervaluation, but do bear in mind we don't look at any of these models in isolation. We then have the dividend discount model. We see the growth rate. Now, it does lack a little bit, especially given the fact that the inflation rate of 4%, we do see 3.14. Forward looking, we've gone not too far off the essential average, so we have been what we believe to be fairly accurate. We get an intrinsic value of $67. Again, another sign of undervaluation. We then have the free cash flow year on year for the DCF model around 20%, going a bit more conservative at 5%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have our third signal for undervaluation. So now we get to the intrinsic value, which is the average of these three models. And this comes in today's episode of $64.71. Also bear in mind, if you want, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, companies on your watch list, or even if you want to run through this again with your own estimates by clicking and grabbing one on the pinned comment below. So we always start off with a margin of safety of 10%. We use that if we believe it meets three criteria: a wide moat, strong financial metrics, and good forward-looking data. So we keep going now until it meets the current price, 15% a buy up to $55, 20% around $51.77. So not too far off a 20% margin of safety. So for today's episode of Realty Income, we see between 15 to 20% on the current value of just under $53. In terms of Wall Street, well, they expect the share price to go up to $62. That is their price target for the next 12 months. They see strong upside of 17%. Now, in my opinion, we are seeing this share price dropping, in fact, not just over the last 12 months, but even year to date, so over the last few months. Now, in my opinion, when we do start to see these rates start to cut, I do believe a lot of REITs as a whole will start to really benefit. We did run through Realty Income. We saw that in reality, from my opinion and from the essential data we have, there's no issue to that dividend safety. It looks very healthy. The adjusted funds from operation continues to grow. There seems to be synergies with essentially the merger as well. So from what I can see for the outlook over the next few years, REITs could really be a very strong contender for outperforming the standard equities. But again, it really does depend on when we do see those interest rate cuts. In my opinion, we will see at least one by the end of this year, possibly two. But if we don't, or if for whatever reason we start to see the interest rates go up, which could also be a possibility, then REITs could go lower. So it really depends on your situation, on your investment thesis, your risk profile, and what you believe for the outlook. But I do believe at the point that we do inevitably see rates go down, Realty Income, along with other REITs that we have covered, will really benefit from this in terms of their share price. As always, though, do let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, subscribe, and we'll see you on the next one.